Hello everyone. Let me give you a quick run-up into what happened in the month of August. It was a period of extreme turmoil in the financial markets, predominantly led by China. In a way, it was a tsunami that occurred on the Chinese shores where Indian financial markets also felt the tremor. So every asset class felt the heat, including capital markets, the currency, selectively even the fixed income markets. But I would want to reiterate the good news here is that the Indian macro picture looks as good as it was earlier. So we would want to reiterate the fact that because of global led reasons, we do not yet believe that it is time to write off Indian asset classes. We continue to maintain that the fundamentals of India will drive the way forward for the Indian policymakers. In that light, we saw a weaker GDP growth, close to about 7%, which would probably create a case for rate easing going forward. The governor has also acknowledged that the pace or the monetary policy accommodation is still not done away with. To that extent, we still remain constructive on the fixed income markets, which would continue to expect rate easing going forward. The liquidity in the system also continues to remain fairly comfortable, and that would render support to the shorter end of the yield curve. To that extent, the view that we maintained last time that the yield curve will continue to steepen remains to be a case at this point in time as well. Let me move on and give you some snapshot on the credit market. Lately, there have been a lot of news, chaos, noises around there being possible, I would say, deterioration in the credit cycle. I would want to reiterate and reassure that in the Indian landscape, the credit picture looks to be much better than what it was in the previous cycle. It is not fair to paint the canvas with the same brush. We would continue to maintain and track, monitor the sectors which we believe could be under potential stress. But we at Kotak continue to reiterate and commit to the fact that the strong processes that we maintain as a fund house, being guided by a stronger parent, obviously makes us that much more watchful and obviously sensitive to the recent environment. The portfolios that we send to you on a monthly basis, kindly urge you to have a look at it for you to get a sense on the kind of underlyings that we maintain on the non-sovereign front, as also on the kind of view that we have forward for each of these asset classes. Broadly, to conclude, we continue to maintain that the monetary accommodation bias will continue for India as a story, which would likely augur well for Indian fixed income as an asset class. Despite these volatilities, if you see the recent past, the yields have been flat to maybe marginally moderate, which have augured well for categories like the bond fund and the gilt fund. So for investors who are looking to play the interest rate curve with obviously some volatility, should continue to allocate funds to strategies like the Kotak bond and the gilt fund. The strategies like Kotak Income Opportunities and Kotak Medium Term, which are bereft of GSEC and continue to have a combination of AAA and non-AAA, thereby offering a higher accrual, will still continue to be favored by investors who do not seek high volatility. So I think that strategy would still continue. There is no change in our stance. We would continue to keep you updated as always, developments on the macro front, micro front, as also developments at Kotak AMC. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.